Good evening, everyone, for those joining, evening, afternoon, or morning, depending on where you are in the world today. Quick disclaimer before we get started, please obtain the advice of a financial advisor before investing in any financial instruments or products, as it's strongly recommended that you consult with a financial professional before using any of the information presented in this webinar. And just as a reminder, this is a purely informational webinar for you. But thank you again for joining us, and we can go ahead and get started. Chad, if you can move to the first page, and I will kick and then hand it over to you.
Sure.
Great. So thank you again for joining us. My name is Gabriela Farias. I am the head of global revenue for the Global Wealth Group. With me this evening are Chad Pope and Andrew Mobsby of Cashbox Global, and they will be presenting two new investment opportunities with Wealth Migrate and Private Wealth Global this evening. These are a bit out of the realm of real estate. These are two structured notes or debt products. We're very excited to be able to offer this to our investment communities at this point in time, and certainly very intrigued with what Chad and Andrew have put together with BBVA and with IDAD, their partners. So Chad, thank you. Chad and Andrew, thank you for joining us tonight, and please take it away.
Gabby, thanks very much. Always exciting to chat to the community. Especially proud of these two particular investments. Love to take you through the basics on how they work again, just as a reminder. After that, we're keen to run through a little bit of a market overview in terms of what's been seen, because those then start to speak to the underlying baskets of stocks that are going to be observed in these two products. These two products, Andrew and the investment committee have put together with IDAD and then BBVA Bank, as we've spoken about. We would probably wrap up the two products and all of this in around 40 minutes, and then would love to open up for Q&A. If you could put your questions in the chat box, Gabby, if you could help us manage that, we'd love to answer everybody's questions. Let's take it away. So folks, we've included this slide as a reminder in terms of the depth of protection that's brought into a product. So what I'd like to do, just for a couple of minutes, review this again. Some of you may have seen it. Apologies for that. Others may be new to it. So let's say there's a basket of shares that our investment grade bank are going to buy options on, and that basket costs a value of 100. Let's say the blue line is a fictitious line, and this would represent the market value of those underlying stocks over a period of time. The reason for showing this in this roller coaster shape is just to make sure we can discuss the different potential scenarios that a market could go through, and then how these products would behave and how we build in the protection into these instruments. So what's fantastic about this, our income funds, which you're going to see now, or notes rather, are designed for steady, predictable income. So if we follow this curve now, and the basket of stocks rises in its first quarter, for example, and let's say, for example, this particular note is designed to pay out 3% every quarter. Clearly, the stocks have risen, it would pay out 3% in that quarter. But what we've done, we've brought three levels of protection. Down on the left-hand side, over here, you're going to see the income trigger set at 50%. So deep levels of capital and income protection are built into this product. So even if this basket drops by 50%, can you believe it? It's going to pay out the quarterly coupon as prescribed. So let's, for example, say this basket runs down, and in the second quarter, perhaps it's lost 10%. We're still well above 50%, it's going to pay out. In the very unlikely event that we get to a scenario like in quarter 3, and the stocks that have been observed have dropped below 50% of their start value, let's say 48%, the product won't pay out that quarterly coupon. However, we've bought the second form of protection called a memory feature. And what this does, we sit tight, and as soon as the market rises again, so in this illustration, quarter four says, for example, that the stocks are now back at an 80% roughly. We're well above 50. This coupon then pays out as it should, 3%. But here's the memory feature. Here's the brilliance. It looks back and it pays any missed coupon. So I'd get a double coupon back here. And so the product would go, depending on its timing, through the market. Now, you'll be able to see from this, we're not in the game of actually having stocks rise too high. We're looking for steady stocks that are going to not drop below 50%, because I want these coupons to pay out on a quarterly basis. So instead of riding this roller coaster of emotion and stock value, we now got the steady straight line. And look at this, we get paid out first quarter, which is defined in the products. You'll see second quarter, perhaps we miss a quarter, doesn't worry me, because it's going to catch it up at some point in time. The next level of protection we buy is called the capital protection level. So right at the end of the product, if it gets to full term, the product is then also protected. The capital is protected to pay out full value, even if the stocks, the worst performing stock in that basket, drops by 50%, which is unheard of, can't be guaranteed, but highly unlikely that that would happen. So our capital is even protected right the way to full term. We do have one other event, and it could be illustrated in quarter 5. And this is called the auto call. And the bank has the right to call the product back if the options in this particular basket rise to a certain level. We enjoy auto calls because we build them in so that we can try and close this product out earlier. So you'll see the two products a little later today, marked at 4 and 6 years in maximum term. But there's an auto call feature that would allow the product to close early. If the product closes early, it's always in our favor. The markets have risen. The bank pays all our capital out and the last coupon. And the reason we like this is because at that point in time, perhaps over here, we have the opportunity to reassess the market and go and invest in what the market is presenting at that point in time. So what we're going to discuss just now is the income trigger level, protection all the way to 50%, should the stocks drop by 50%. We've got the memory feature. In the unlikely event that a coupon doesn't pay, it will pay out again. We have the auto call feature, which allows us to get our cash back early and go and reinvest. Or should it run to full term, we still have this capital protection right the way down to 50%. So I'd like to show you this in action. This particular note we created in February 2020, just before the market crash. We're going to follow Twitter because this Twitter was the stock that dropped the most in this particular basket. When the stock started, it was at $36 a share. Because of the income barrier, we would receive an income even if the stock dropped by 50%. So we only needed to achieve $18. The low in March, 17th of March, was the lowest for Twitter at -40. Do you see, even if the coupon was being observed or the observation was at this date, we were still 10% above a normal threshold. And look at this, that whole roller coaster is in action now because the stocks have come back 17, and just at the beginning of February, I had a look again, they've gone up like 38%. Now, do you see in this particular example, all these stocks have risen above their start price. And what you're going to see now, what you're going to see just now is this product has an auto call feature that says if the stocks have risen above their start value after 12 months, the product can auto call. So the folks that were in this product were getting 3.3% a quarter for the full year. They're going to get all their cash back, highly likely, because we're deep in the money, it said. Over here, they're going to get their money out, and they're 14.2% for the year. Tremendous returns. So there you go, just to see that the protection at work. So even through the roller coaster of 2020, all the coupons paid, as it did for all our products that we ran through through that crazy year. Not that we're out the woods yet. Andrew, if you don't mind, would you give us a view of where we're at now as it's seen, and an introduction into the product?
Certainly, thanks, Chad. Good evening, everybody. I'm based in Cape Town, and summer is still with us, so we're delighted. So reading ahead, the rationale 2020 takeaways and 2021 market influences, I guess I'm not going to say too much about the year that we've had and where we've come from. So much has been written about it. We've all been in it. We've all been touched by it. And there are so many takeaways in terms of how life has changed. I think that's the biggest, perhaps the biggest takeout in terms of how culturally we've changed, our interactions with people, business modes, work from home, e-commerce, online portals. It's a world that was in the future, perhaps a year or two ago. And we found ourselves very suddenly living in that future during 2020, adapting and changing to the pandemic as it swept, from east to west across the globe. So without saying too much on that, I'd rather try to spend some time in terms of, what are the green shoots that have come out of 2020 against which we have created investment baskets that we will use in our notes. And I think Chad eloquently spoke about the fact that these particular structures does not mean that you, the investor, own those shares, okay? And we're going to go through these basket of shares in the two notes that we've constructed. We don't own those shares. It's the reference of shares that the investment bank would like to own at a point in time. So it buys options on those shares. And the shares that you will see that we've actually put into the baskets are two very different combination baskets in the next slide before we go to it. They're all household name companies, very big Titan structures, behemoths, super tanker type shares, household names, very strong, powerful companies. And I think if I can just use one short strap line without upsetting anybody, size does matter in the approaches we're going into. And it matters simply because we are not looking for out and out exponential growth. The nature of a structured note is not that we shoot out the stars, shoot out the lights, and create, as I say, exponential inclined growth. If we get 1 or 2%, that's brilliant, because contractually, the bank has contracted to pay you a predetermined, predefined coupon return. Okay, and Chad took you through the roller coaster of the ups and downs. So these products work in sideways, downwards, and upwards markets. And I think we're staying with big companies, these Titan structure type companies, simply because we're going into a new space where 2020 was a very odd year in terms of markets. If I have to confine my comments to the US, for example, and there's quite a few of those bullet points there that are specifically for the US. You talk about the US presidential election, the influences of COVID on tech and stimulus spending. Those are particularly relevant to the US. Stimulus spending has been right around the world. Governments, World Health Organizations, literally everybody's been throwing money at the problem. Ultimately to keep businesses afloat, to keep individuals alive, to reignite businesses, and to save businesses, the shareholders, the staff, whoever it might be, the balance sheet of these companies. But what happened during 2020, specifically in the States, and it was happening before, the advance of the digital age, the advance of technology was creeping faster and faster into mainstream American life. And all that 2020 did was cement those companies that had gone into that space aggressively, cement them in absolute, prime or pole position, and cement their dominance in either their sector of the economy or within the space that they were active. So the companies that are in the US tech notes, and there's two notes here, were doing extraordinarily well before 2020 came along. These are not flash in the pan. Nobody's heard of them before, and they did very well because they happen to be in the niche. These are mainstream companies, and you'll see why when we go to the next slide shortly. The same must be said for the UK. The UK Titans. These are mainstream FTSE 100 companies, very large, somewhat dour. There's a bit of a nickname for them, steady eddies, because they behave, unlike how the tech stocks behave, they behave in a far more predictable fashion. And those particular stocks, for example, in the reference basket were ordinarily bought by investors for a dividend, because they were great dividend companies. They were not growth companies, they were dividend paying companies, maybe at 6, maybe 7% in that sort of area. Whereas the tech stocks in the tech space, that is the NASDAQ in the US, Amazon and Apple are all in the $1 trillion cap market. Certainly Tesla, so much has been written about, the company. It's quite incredible for a 20-year-old company to be in the top 5 in terms of market capitalization is just absolutely enormous achievement. Having said that, there's a lot of speculation about, are these companies overvalued in terms of their balance sheets and their earnings? And I think what I put into perspective, and what I get perspective from, is that those changes we experienced in 2020 something has to be said for the way that companies are now being valued. The traditional way of valuing a company is its earnings against its price that you pay for it. Many of those rules were torn up and thrown out the window. And the recovery that we saw specifically in America was dragged upwards in a very narrow range by the technology type of stocks in the digital space. There are a lot of companies in the US on the S&P 500 that are seriously languishing. And in there's opportunity, because a lot of those companies have had huge destruction of value because of the sectors that they're in, whether it be hospitality, travel, you name it. There's good value opportunities. That value opportunity is perhaps more evident in the UK, in the sterling-based note, which is the UK Titans. A lot of those companies have had, during 2020 and slightly before that, saw a huge reduction in their balance sheets in the price of their shares. So they are sitting at a more value-rated opportunity for the bank than maybe the tech. And one has to draw the assumption that, why is a bank prepared to pay that much more for your tech stocks than it is for your steady eddy stocks? Well, it's simply that the tech is fizzing and bubbling along and frothing along, and it's more than likely going to carry on doing this for some time. The tech revolution and the digital space is not going to stop overnight. It's a little bit about a conversation I was in about the technology and the vaccines. One of the bullet points in the previous slide was vaccine and immunizing the herd. Now, the herd colloquially is known as 60% of the world's population, and you can break that down per country. But it's simply by having the vaccine and the vaccination process and the logistical rollout and sometimes nightmare of that, doesn't mean that COVID or the pandemic is just going to evaporate. It's going to be with us for a long time. Many of the ways how we act, we interact, we behave, we trade, we do business, etc., are going to be with us in this new space for a long time. So many of these companies are going to carry on powering their way through. It's very interesting because in the last 2 weeks, 3 of those companies in the tech space, in the top basket, delivered their Q4 2020 earnings. So they delivered to the marketplace what they produced for the last 3 months of 2020. And they all shot out their estimates. They all beat their estimates. They all did far better than what the analysts expected. Yes, whilst there was a lot of profit taking, those trajectories have carried on. There's a great deal to be said for AMD, which is the smallest. Advanced Micro Devices. It's the smallest stock of all 3, and that's just shy of $200 billion. So it shows you the size that we're dealing with. When it comes down to the Titans, I go back to the opportunities that present themselves in the Titans. Sure, it's offering a far lower trajectory of projected yields, okay, in terms of its coupon. But both of these products have something that's quite unusual to them in terms of how they might behave, and that is the auto call. Chad mentioned earlier this feature, this function called auto call, which is just another word for an early maturity. And contractually, that is built into each of these products. Every product that come out from the bank has an auto call. So in other words, in this particular instance, the UK Titans has a 12-month auto call. In other words, 4 quarters. On the 4th quarter will be the first opportunity that this could mature early. And all that would mean is that those 4 stocks collectively, if they were all the same price as they started, or 1p above what they started, if we talk sterling, it will auto call. Contractually, it will mature. The same goes for the tech stocks. Now, the tech stocks is more interesting because the bank, when I say falling over itself, it's not quite, but it's looking to acquire these shares at a discount through options. And they're prepared to pay a really frothy coupon of just over 4% euros to attract more investment money in there. But they've shortened the auto call line down to 6 months. So in other words, from start date to potential first early maturity observation is 6 months away. I think it's something the 26th, 27th of August. So you'd pick up 2 coupons and then the investment would end. That's the end of it. Can't go on, it would end. Money, the capital would be returned, your money would be returned to your platform with the coupons that would have been paid out. So you can see there's a greater preponderance for these frothy shares than there are for the perhaps more dur. But I certainly believe that there's an equal opportunity that they both could mature early, given the one's coming from a value proposition and the other one has got this enormous momentum behind it from terms of growth. So just to round that off and encapsulate it, it has to be seen against the matrix that is the world. And we certainly believe, the US is fertile. It's come through a lot of uncertainty. The one thing that investment markets hate is uncertainty. There was a lot of uncertainty about, was a vaccine going to be found? Was there going to be a peaceful transition of a new president to a new administration? Would stimulus spending end? Would it stop? A lot of those questions have dissipated and gone away. Even the trade war will probably be a lot more benign with China. So there's a great fertile opportunity with a wall of money that's been sitting on the side. America has never been this cash flush with the spending and the support from the Federal Reserve, that once that money starts coming into the markets and people start spending right across all the economies, as we see more and more vaccinations, more and more people and towns coming out of lockdown, spending will happen. It'll come through to the earnings and everything, all boats will rise at the same time. So a very, very opportune time, we feel, to invest. This time last year, we saw those pictures in China of them building hospitals to accommodate thousands and thousands of beds and building them in 5 days' time. And we thought probably it may never come to this part of the world. It's an Asian thing. I think to invest last year, and we had great difficulty with the banks to try and get prices in terms of pricing these type of notes, because people, investors, bankers, analysts just did not know where we were going. And certainly, as Chad mentioned, we were very lucky to launch a note just before the real mineshaft collapse in March. And that is actually maturing. Tonight is its last observation. As he mentioned, good old stockbroking term, deep in the money. And there are some delighted clients who will be extracting their 3.3 times 4, which they've had paid over the year, and their full capital tonight. So a great opportunity. Obviously, the markets have shown a huge yo-yo bounce back up, but it's been narrow. And I think the difference between 2020 and 2021 is that it's going to be a lot broader, and it's going to spread right even into the steady eddy. So we're very confident, we're very positive about the fact that we build in protection. We are looking for the protection of money. We build in these features like the memory feature, the auto call, early maturity. And these type of features you don't see in the retail model. This is the product that is alive. It's the US tech. So a lot of these, a lot of the terminology and the facts and figures we've been talking about, you can see jumping about all over the screen. Again, this is bottom right. It's closing for investment. Let's deal with the elephant in the room. We've got probably 2 weeks to get onboarded, get the money across into your platforms. It's got a 4-year maximum term, so it's only 48 months long if it had to run to complete term. Given that you've got an order call after 6 months and then quarterly thereafter, every quarter the opportunity presents itself. huge opportunity for this to be a liquidity event somewhere down that timeline, which, as Chad mentioned, you got fantastic opportunity to reset, to rebase, to have a look exactly where you are, and to go again, fill and go again, so to speak. Great levels of protection. These companies, these massive household names, will have to halve in value before your income stream is disturbed. Now, that's saying something, especially that we went through probably the worst crisis crash in maybe 100 years, since 1928. Okay. And certainly the stocks that we chose, certainly that went into the basket, Twitter, we saw minus 40. You saw Apple, and you saw a few others at minus 30. But we had great protection down to this minus 50. You don't generally get that on a retail basis. This is what is structured at institutional level. And we're delighted to have democratized it to the point of bringing it onto the platform with yourselves. There you see your stocks sitting there. Oh, interestingly, the auto call trigger, I mentioned the banks are really keen to get hold of these shares. So they're making it even easier. So what does 90% of initial mean? It means that at 6 months and quarterly thereafter, the prices only have to be 90% of what they started at. So they're giving us almost a 10% leeway to say they only have to be at 90% of what they started. And if they are, that's the story. All 4 of them, in both instances, when there's an order call, all the constituents must behave. You can't have one doing its own thing and well below. They've all got to be at the T's and C's of what they're supposed to be. Otherwise, it just continues for the next quarter, paying its coupon and waiting for an order call. So certainly, this is the basis of what a fact sheet would look like. Chad, if you want to go on to there's your euro quarterly coupon, 4.05. Just on that, before I get to this, just to give you some context and perspective, you're looking at probably 4 to 6% per annum euro if you start looking at longer term deposits. So literally, we're coming in at 4% per quarter. So massive X factor there. This is something that appears in the fact sheet. Each fact sheet has its how should I put it, observation dates, its schedule, its calendar. So you can factor this into your cash flows. We've just taken the first two lines. Your first observation, believe it or not, may sound not far away for me. It sounds around the corner. But on the 26th of May, you'll have your first observation, and 7 days later is the payout. It's always 7 days. The bank does its reconciliations. As you see there in blue, it only has to achieve 50% of what it started at, those 4 shares started at, and the payment will happen. And obviously for the first quarter, in terms of the terms and conditions of this note, which says at 6 months, there's no order call at 6 months, but that certainly kicks in the following quarter, at the end of the following quarter, where at 90% of your start prices, this can actually end with full capital and the last coupon back. So 27th of August, and so on and so forth. It goes right the way through to the final observation, if it lasts that long, if it doesn't early mature along the way. So 4 years is quite a view. So, the bank, when it puts this together, it's not a throwing together of 4 arbitrary companies that sound good, that sound, well, these are the flavor of the month. It sounds, it sounds good. Let's put them in a basket. Algorithmically and from a deep pressure testing perspective, there's a lot of work behind the scenes that goes into this in terms of creating the value of seeing where the opportunities lie for those companies in a basket together. The same goes for the UK Titans. It's not a conglomerate of just shares that we like. So let's move on to the UK Titans. It might seem like the bridesmaid compared to the frothy 16% odd of the euro option. Again, we've been through the companies. Again, here you've got 100% after 12 months. If they're all at 100%, it ends. Simple as that. Your underlying basket, you've got British American Tobacco, BT Group, Vodafone, and BP. They've all taken quite a pumping during 2020, and they're all in a far different. They're not in the growth space; they're in the value space. So they don't have to do much to actually climb out of where they currently are. And there's great opportunities. In terms of those, there's two telecommunication companies here, telecoms, BT and Vodafone. 5G is the new thing that's coming to the world. It's going to be $1 trillion space in terms of where people will be doing business. 5G just relates to the speed, not just of your smartphone, but of everything related to that digital space. It's going to revolutionize a lot of people, and I think politically it's being wrangled over in terms of who. It's like a bit of like the space race, who's going to own it. But moving away from that, just to explain the coupon rate, this product hasn't been fixed. The other one is running, it's fixed. The terms and conditions are baked into a contract. This one has not been hedged from the bank, from BBVA, because we're busy with the raise. In other words, once we hit $250,000, we will then probably close it, and we will hedge all the terms and conditions. At the moment, we have a range of between 7 and 8%. I did a repricing recently, and it came out with 8%. So we're talking 2% per quarter, which is pretty much in line for these sort of steady eddies. The bridesmaid, if I called it incorrectly, I'm sorry. Again, you've got very deep levels of protection. So very similar to the first note, deep levels. These companies have to halve. These go to the social fabric, in as much as they are UK companies listed in the UK. They are multinational global companies with revenue streams from all over the world. So very, very deep levels of protection, very great income triggers. It's slightly longer at 6 years versus the previous one at 4 years. And as I said, auto call, early maturity potentially after 12 months and quarterly thereafter. So 2 horses, same courses, they're all in the same environment. The bank has looked at these. They're not in such a rush to accumulate these type of shares, because they need to get hold of the stocks that are hot at a better price at the moment. So those are the 2 products. I say this one's in book build. There is ultimately a clock running. We can't keep it open forever, but we're building this, and as soon as the actual minimum prescribed level is reached, then you'll be contacted to say the actual issue is closed. It will then be, the contract will be struck. There'll be a start date, and off we go. Very much like the US tech model. So Chad, I'm going to sort of hand this back to you now, cool. In terms of where does everybody fit in. Thanks very much.
All right, Andrew, thanks, man. Always insightful, always fascinating to listen. So folks, in terms of the role players, just as a reminder, Cashbox creates the opportunity for this investor group. The intention is to bring institutional grade investments with deep levels of protection to a group of like-minded investors. How do we do that? We deal with IDAD. IDAD have the software, the modeling software, and the licensing. They're UK-based and regulated financial services. And they have a direct link to the investment grade banks down here to create the products. So in the 2 products that Andrew was chatting around now, ideas are formed, ideas are then taken to the investment grade bank to see who's interested in raising this. So who designs the product is actually a group, Andrew, the team from IDAD, and then the investment grade bank. The 4th group to have a look at the product is the investment platform. An investment platform is the right place to go and buy any ISIN regulated product. So you can track and trace this product through all the financial instruments around the world, and it needs to meet certain criteria. So risk and compliance in all these areas have taken a look at how the product's structured. And the big one, of course, is the investment grade bank, because they're going to underwrite the product. Now, what's nice about this model, the investor stays in the center of the universe. There's an advisor off to your side, being tax, legal, wills, investments, whatever you need, always to oversee what you're doing for the advice that you may require. But what we've done is we've removed the advisor from between you and your investment, cuts the middleman out, takes the cost out. So what we all need to do then is have the investor platform in steps Global Wealth group, and creates a platform for us to invest off. So this is a regulated platform. Investors fund their platform, they instruct their platform to invest in the product, utilizing that ISIN reference number. Now, the platform actually owns the contract from the bank, not Cashbox. This is very important. The investment bank's contract is owned by the platform. all funds flow from the platform directly to the investment bank. No funds flow through IDAD or Cashbox. And this is really cool because, again, there's nobody circulating, nobody between you and your investment. So all the contracts, funds flow, platform bank, back to your platform, and then ideally with this digital wallet, you're then able to have a look at the next opportunity and go and invest where it's required. So perhaps in the one product, we can order call, let's say in 6 months, 9 months, maybe you take your 8 or 12%, reinvest it again, and your capital, you can have a look. Maybe it's other opportunities, maybe it's other structured notes, and ideally it's a group of structured notes to start to build up a bit of a portfolio. Nice balance, I think, between the steady Eddie at 9 and what do you call it, Andrew? Fizzing tech notes at 16 could be ideas that you may want to play with. Just to give you an idea of who's involved in the flow. The risks to consider, as you've seen before and as you've determined from the graphs and the contract, the issuing bank remains key. And that's why we will only deal with the A-rated investment grade banks, Fitch and Moody and the like. So BBVA is one of those, as you've seen as the underwriter of the product. Of course, the underlying stocks, the options that the bank owns as its reference basket, the options we need to track and trace and make sure that we are where we need to be. Now, again, you've had some quality eyes have a look at making this basket up. Again, we intentionally trying to stay as flat as possible or on a rise so that we can try and get to an auto call early and probably not go to full term. In terms of the track record, IDAD and our affiliates have created nearly 1,300 of these contracts over the last 10 years, a 96% delivering exactly as the returns were intended. The other 3.7 odd percent was when clients come in with specific bespokes, some stuff around oil and gas, and some really tricky stuff was done. Unfortunately, not all the coupons got paid out. But in 2020, Cashbox created 8 notes across the year, all coupons delivered, all contracts running. As you saw, the stress test through February didn't impact it at all. Paid out, we've paid out to clients already 14% in pounds for those that invested in pound-based products, and 12% paid out in USD. Some of these have now auto-called, full capital, and those returns are out, and go again if you like. In terms of the fees, and I alluded to it in the structure, 100% of what you've invested gets allocated to the fund or to the structured note rather. So if you're going to invest 100 off your platform, 100 goes in. Cashbox receives a placement fee from the issuing bank for aggregating these funds, and that doesn't come out of your capital. So that's structured into the contractual agreement, into the raising with the bank. And of course, you just want to check your investor platform. We also have some sort of placement or annual fee, transactional fee, hosting fee. You want to just double check what those all are. But a very fee light arrangement. At last, most of the returns going back to the investor where it should be. I hope that answers a whole bunch of things. Andrew, we've done well at 41 minutes. Gabby, we'd love to answer some questions. I had one come through on my cell phone as well. Shall we hand over to you?
Yes, that would be great. So I see that we've already had a few questions come in through the Q&A box. So please feel free to direct your queries there so we can get through them with the time that we have remaining together this evening. Right off the bat, I do want to ask, direct this to you, Chad, I suppose. But if you can clarify, relevant to the value of the investment at the time, do investors get 3% per quarter based on start value, or is it 3% on that fluctuating value per quarter? Maybe we can go back to that graph that you presented. And I think the 3% referenced here was the percentage used in that example.
Just as an example. So if we took the UK Titans, these would be 2% a quarter, or roughly 4% in the Euro high-tech stock. So as long as we are 50%, above 50% of the start price of that basket of stocks at any point in time, it would pay out those quarterly coupons. So it gets measured every 3 months and understood what the reference basket started at, where it's at now, and as long as we're above 50%, it will pay out. So it's like investing with an insurance built in. The only time it may not pay out is if we breach the 50%. And as Andrew said, to take off 50% of Apple or of British Petroleum, I mean, it's highly unlikely, highly unlikely, as you saw from the previous graph, from one of the largest dips. Did I answer that question?
I think also, Gabby, very simply,
Yes,
let's take
that's
a very simple example. You put £10,000, $10,000 euros into an investment. The coupon that is contractually determined, let's say 3%, is against that 10,000 right the way through those ranges. So the chart that we're looking at, as long as it remains within that range, if it's 10,000, you'll carry on getting your 200 every quarter. So if the price goes down, your 2% real value does not go down. It's against the initial investment amount, as long as it stays within that range.
great. I think there's also been some confusion on one of the charts used later on. It may have been for the tech,
Okay.
Can I go there?
the US tech one, but it's related to capital. There's a note there that said capital not protected. Perhaps it's capital protected all the way to 50%. So I think just clarifying that again with what's been shared.
Great. So Denise sent the same pictures. Thanks, Denise. Good question. Andrew, do you want to go for it?
Yeah, certainly. Okay, so a couple of issues here which will give comfort. We choose very carefully with our affiliates the type of bank that's going to underwrite this debt issue, because their balance sheet has to be very robust, has to pass muster, it has to have all the right credit rating agencies, A sort of ratings. So what the contract means is that during the term of the contract, your capital is protected by the balance sheet of the bank. So as Chad pointed out in risks, your biggest risk is the credit issue, which is the bank going bang. That's why we really need to be in bed with a very, very large, big, robust, well-regulated bank. So during the term of the contract, your capital is protected. Your capital is not protected if it runs right the way to term and at the very, very last observation. So Chad, I don't know if you, or Gabby, if you can go back to the screen, beg your pardon, the chart. Yeah, there. So it's protected all the way through, but at the last observation, which is actually your end point, your maturity point, if it runs to maturity, your 4 stocks have to be within the terms of reference. In other words, they have to be above 50% of their starting value for your full capital to be paid out. So on that last observation, your capital is at risk, because if one of those 4, even if it's just one of those 4, has fallen below the 50, let's say it's really had a cataclysmic event, it's imploded, and it's down to minus 60 of what it started at, that means your capital is at risk and not fully protected and will be reduced on a one-for-one basis. In other words, what that means in plain English is that if that is the case and one has had one of these events, and let's say it's gone down to minus 60, it means that you will have a minus 60 degradation of your value. In other words, you lose 1-for-1, you'll get 40% of your initial investment out. So therein lies the risk. And that is why the choice of the bank for the term is very important, and the choice of the underlying reference basket is crucial. Those are the 2 major issues. And that's why we can't, and I'll say it bluntly, mess about with small companies who have, up and down sort of behavioral traits. We need something that's, even the big frothy ones are a little bit steady and eddy, because they are driving the recovery of world economics. So in brief, as long as the shares remain performing right the way through, the only time that they're at risk is that final observation, in which case if one is minus 30, one is minus 40, one is minus 45, and one's plus 5, You get your full capital back because you're all above the minus 50. It's only when you go below that one observation right at the end that capital is at risk. And that's why we cannot say this is a fully capital protected product, because then you have to have it protected right the way through. And if you do that, you've got to pay the piper, as I call it. In other words, the bank will have to guarantee the full capital. And what they do is they take it out of the coupon or the terms and conditions to build in capital values. And that's when you really fall into the retail space of maybe getting 4 or 5% per annum or 6% per annum. You might get different terms, you get all sorts of different issues to protect your capital. So yeah, there are higher returns here, and there is that risk factor at the end, but it's a qualified and I would say educated risk that you're looking at.
Great, Andrew. If we can talk about the auto calls for both of these notes. So the auto call for the US tech is after 2 observations or 6 months, I believe. And the auto call for the UK Titans is after the 4th at the 4th observation, so 12 months. We have questions here from some of our investors on early exit, if there is an opportunity for early exit or if there's a penalty for early exit prior to those auto calls taking place.
Certainly on an auto call, it's a contractual condition, so there's no exit penalty for that. If it calls early, the bank's happy, it's getting its options, you've made some good quarterly payments and you get your capital back. If, for example, there is a situation where the contract has to be broken, because that's ultimately what it is, you're breaking your contract in terms of the T's and C's, it works on the basis of a willing buyer, willing seller effectively. So you may very well find that those particular stocks, the reference basket stocks, are doing rather well. It's got a fantastic coupon attached to it. You might very well find a lot of interested buyers. We generally go back to the structures and say, would they be interested in buying it? There has been the circumstances where they have bought notes back. So you can actually exit the position in exactly the same position you went in. But having said that, let's take a really real example. If you were trying to exit during the course of last year, let's say in April, May, and you were terrified that your 50% protection wasn't going to be enough and you'd rather get out then, you would have found very few buyers. As I mentioned, the banks were not pricing anything. Everybody was sitting on their hands. It would have been, you would have got out potentially with a carpetbagger having picked up your investment for quite cheap. So there's no guarantee. It's not like a unit trust or a mutual fund where there's a legal obligation on the structure and issuer to repurchase your units or your holdings. This is on far more on a willing buyer, willing seller market pairing type of situation. Yeah, that's the short answer.
I think, Gabby, it's much like a property. If the term says maximum 4 years, be prepared for 4 years. It's far safer. Yeah.
Sure. Great. And a question on the US tech 50/50, if that is available in euros rather than USD or GBP. Andrew, could you speak to that, or Chad?
Are you saying, is it available in other currencies?
Yeah.
Yeah, so the situation is that when we develop this particular product, we don't often see euros. Euros is actually, for whatever reason, rhyme or reason, they a decent note to be hedged in euros is almost as rare as hen's teeth. Certainly, I have not seen one in this shape at this level at over 4% per quarter. For a very long time. So it was very refreshing. We were very chuffed that we were able to put it together and for the bank to underwrite it. It's available in sterling as well, and it's also available in US dollars. The rates of those other currencies are slightly higher, and that is relative generally to what's known as the credit swaps between those three. So in US dollars, just to give you some context, the US dollar is contractually hedged at 4.5% per quarter. So, that's a heck of a coupon per annum. You can do the maths. And sterling is at 4.25% per quarter. So again, a heck of a coupon. I personally feel that banks are probably reaching potentially the top end of the curve of coupons. These are very, very solid coupons with very, very solid investment basket rationale, with a great issuer, short time frames in this marketplace, which is, if I can use the expression, it's a bit hackneyed, is pregnant with opportunities. There's lots of green shoots, and I would love to be able to turn around to people and say, I'm so glad you invested in 2021 at the beginning, especially that you are investing in a product that has got protection built into it. Sure, if you were looking for out and out growth and you had that risk factor built into your profile of out and out growth, then go buy an Apple, go buy an AMD, go buy a Tesla, and go for it. This is, as Chad mentioned, we are not looking for growth. Growth would be nice to trigger the order call. This is for predictable and certain earnings that are contractually built in. There's a timeline. Those the chart that we looked at, or the page that we looked at with all the observation dates. Your coupon payment never changes. It's always the same amount. So if you've invested 100,000, you're going to get 3,000 a quarter if it's 3%, or 4,000 euros if it's 4%. It doesn't change. The dates don't change. It's predictable and it's certain because it's contractually underwritten, and it will, it gives people certainty in terms of maybe planning for their cash flow for a year out or 6 months out, because you need to actually start thinking about it when's the first potential auto call. And I've been in situations where clients have said, whoa, I don't want this to auto call because this is a fantastic coupon. I'm not going to find it again. And we might not find 4% again, but it's a contract that says if the T's and C's are satisfied, the bank will call the product in, early mature it, return your capital, and you'll be paid your coupon. So we would then have to source a new home, a new investment, but it also gives you the opportunity on quite a short-term basis and quarterly to have a look to see if there's going to be a potential early maturity. But I think Chad's words ring in my ears. When I sit with a client, I said, these are all great features, but plan for 4 years. Because if you're in it for 4 years, you need to have that money committed for 4 years. This is not money for school fees. It's not money for a short-term acquisition of a lifestyle acquisition. This is an important part of your ultimate wealth portfolio that should actually be sitting in your fixed income portfolio. Because we're not looking for growth. Otherwise, it'd be in the growth portfolio. This is more income portfolio to derive a solid, steady stream from a reputable issuer, easily understandable, hopefully via your platform, clear line of sight in terms of how the money moves to the investment bank and the coupons move back towards you, cutting out as many costs as possible, so that the return of 4%, if we're talking euros, or 8% in the sterling example, as much as that comes to you, as I mentioned, the 4%, that's 4.05 in euros, or 4.5 in dollars, or 4.25 that's the fee that is the coupon is actually paid to you. The only charges that you need to be concerned with are ultimately the charges that are applicable through your platform provider for the services they hold as they're custodial. They have a custodial service.
Andrew?
Yeah.
Sorry, if I could just add, Gabby, we were asked to find a euro product and a dollar product, and a euro and a sterling opportunity, which is what we've created. It was in order to diversify across currencies as well on opportunities on the platform. However, I understand from your management that if there's sufficient interest in the dollar, they would look at that as well. So I guess the question would be to understand the interest in that product.
Certainly, and that's something that we'll be keeping a close eye on from our investment community, is if we see that there is a growing interest or request for that dollar option. I do want to address some of the similar questions that I'm seeing come through as Andrew has been talking over percentages and returns. So our investors can invest on both our Wealth Migrate marketplace and our Private Wealth Global marketplace. Something to keep in mind is on our Wealth Migrate marketplace, that is that holds a minimum investment of $5,000 at a 3% investor fee. For those that are looking to invest a bit more, you can invest on our private wealth global marketplace at a minimum of $25,000. And if you joined our Wealth Migrate marketplace after February 1st, when we first launched, you can enjoy a 2% investor fee. So would strongly encourage you to reach out to our investment team or your wealth consultant. Either reach out to them directly or contact us at invest@privatewealthglobal.com just to answer any questions that might be specific to you related to tax or setting up your LLC or trust that you may want to invest through. So I just want to address that here. If there are any other questions on that, please, again, feel free to reach out to me directly or your wealth consultant. With the time that we have left, though, I do want to address this great question from Fiona, which is, why would you go for the UK Titans over tech stocks with more favorable returns? I think we've talked a lot about how frothy and spicy the tech stocks are, and how steady the UK Titan stocks are. And Andrew, I remember in our conversations last week, you saying it benefits or behooves you to invest in both. But curious if you have more that you want to elaborate on there.
Yeah, so I mean, really, it's a particular question that I think you need to factor into your own portfolio. So in terms of what your portfolio is looking like, if you're looking for slow and steady growth, or that might last for 12 months, it might go longer. Alternatively, going into something a little bit more frothy. And probably the frothiness of the tech stocks is there because the valuations of these companies is really, really high. There's been a huge momentum of people chasing those companies that have led the recovery. And quite frankly, are probably going to stay there. But the question you've got to ask yourself is that it may very well end at 6 months. So you will have achieved 8% in euro in 6 months, which is a phenomenal return if you think what you're earning in cash. But certainly the opportunity exists for a compromise between something that might last a lot longer to something that might last a lot shorter. It needs to be looked in your time frame of what you're looking to achieve in terms of cash flow. We've been on quite a few webinars where I think some clients prefer to, I call it the bright and shiny, and that's maybe the tech stocks, that it looks fantastic. And believe you me, it has been the sort of darling of the investment space for the last year, since March. And these value propositions in Titans don't need much to come off the value space. You're getting 8% in GBP. And you probably, after 12 months, you don't have to do a lot to mature. I think the appetite of the banks is perhaps also something that you can draw something out. The banks are prepared to pay quite attractive coupons to secure these stocks now. To pay 4% is they are paying a premium to get your money, to take the option to potentially buy that stock down the road if it still makes sense. It doesn't mean they obviously have to buy it. Let's not get into the technical side of it, but it gives them a huge opportunity to get a discounted quality company and pay you something worthwhile. So it really it's a tricky question from the point of view that everybody will have a different reason for putting it in their portfolio. Your portfolio might be underweight the tech space that you must start on. If that is the case, there might be a very cogent reason for including it. You might have gone, right up to your bootstraps in tech or the digital space, and you might want something a little bit more sedate on the steady eddies to complement that. It's very particular to each person's portfolio. So I would advise that one would need to look inward and say, what am I actually looking to achieve? But again, at the end of the day, they both sit in the fixed income space. As I said, we're not looking for growth. If growth comes, we don't enjoy that. We've given that up for the protection. In other words, we've sacrificed going into the growth space to get a decent coupon and to build in deep levels of protection.
Well,
Talking
thank
to
you
myself.
so.
I think what's pretty cool about this is you could start to build a portfolio within a portfolio. So, you know, if it was a bit of both, and then you see what else comes up as these come through the months. And also what you might do with these coupons. So you could start to build a portfolio of structured notes, which is rather attractive, which were the kind of returns we were intimating and indicating a bit earlier.
Certainly. Well, thank you so much to both of you for your time this evening, for giving us all of this incredible information on not only just these notes, but their structures and educating us there. For those interested, Chad and Andrew did record an educational webinar with us last week, and we are going to be emailing that out to our community as well. So if you do have any additional questions on structured notes, on Cashbox or iData as their partner and how these are put together, certainly reach out to us or take a look on the deal page for both of these notes. Thank you again, everyone, for your time, presence, and attention this evening. We will be sharing this presentation and this recording with everyone who has registered for this event. And it can also, again, be found on the deal cards for both of these notes on our marketplaces. Thank you so much. Have a great evening.